Okay, let's unpack this. For anyone who's ever felt like, they're drowning in a sea of financial news, just bombarded by conflicting advice, or maybe simply wondered how to truly make their money work for them over the long haul, well, this deep dive is absolutely for you. Today, we are embarking on a really insightful journey. We're going into the often complex world of investing, but this is key. We're doing it through the remarkably clear, data-driven lens of one of the most influential figures in modern finance, Dr. Jeremy Siegel. We've meticulously pulled from his seminal works, particularly Siegel's Guide to Enduring Stock Market Wealth and his cornerstone book, Stocks for the Long Run, a wealth creation guide. And these aren't just theoretical books, right? They represent an empirical, almost surgical approach to dissecting over 2 centuries of market history. Our mission today is pretty straightforward: to cut through all the noise, distill the core wisdom on how to build, enduring wealth in the stock market, and help you gain a profound understanding of why time, patience, and a long-term perspective are, well, without a doubt, your greatest allies in investing. We're going straight to the statistical defense of equities, giving you a shortcut to being well-informed.
Yeah, and what's fascinating here is that we're not just discussing opinions, you know, or the latest hot take from some pundit who's just reacting to the last quarter's news. We are truly diving into over 200 years of empirical market data, meticulously compiled, meticulously analyzed by Dr. Siegel himself. So this isn't just about what to do with your investments. It's about deeply understanding the fundamental why. Why have certain approaches consistently worked over centuries? It offers this powerful historical bedrock for your financial decisions. It really provides a level of confidence that, frankly, very few other investment philosophies can genuinely claim.
Okay, so let's start with a statement. It might seem deceptively simple, maybe even obvious to some, but it is, in fact, the fundamental, almost radical claim that underpins, well, every single piece of Siegel's extensive body of work. He states unequivocally that over long periods, stocks outperform every other asset class.
Every single one.
And when he says every other, he isn't being metaphorical. He means everything. Gold, bonds, short-term treasury bills, T-bills, even real estate. And crucially, this holds true even when adjusted for inflation.
Right, after inflation.
Exactly. This isn't a hunch or just some theory he cooked up. He's saying it based on centuries of rigorous data, specifically from 1802 right up to the present day. It's a powerful assertion because, let's face it, it challenges so much of the conventional wisdom we often hear, which tends to focus on, short-term jitters or the perceived safety of other assets.
That's exactly right.
Yep.
And Siegel's research doesn't just make the claim. It meticulously lays out the historical performance. The numbers truly speak for themselves, and this is especially vital when we look at them in terms of real return.
Okay, define that for us quickly.
Sure. Real return is simply the return you get after accounting for inflation.
Got it. Your actual buying power.
Precisely. It reflects your actual increase in purchasing power, not just, the number going up nominally. So, for instance, his data shows that stocks, specifically broad market indices like the S&P 500, they've delivered an average annual real return of approximately 6.7%. That's since 1926.
6.7% after inflation for almost a century.
Exactly. Now let's compare that. Bonds, which many people think of as a safer long-term bet, they come in around 3.5% real return.
Okay, big difference already.
Huge difference. Short-term T-bills, often seen as basically cash, super safe, about 2.6%. And then there's gold, that classic safe haven, right? It's only managed, frankly, paltry 0.6% real return annually over that same vast period.
0.6%. Wow.
Yeah. And when we talk about these numbers, it might seem like, a few percentage points here or there, a mere whisper maybe. But the significance of these seemingly small differences, it becomes absolutely massive when you compound it over decades.
Right. The compounding effect.
Exactly. Imagine for a moment a financial snowball rolling downhill. If that snowball is growing by, say, 6% each year after inflation, it's not just adding a fixed amount, its growth itself is growing.
Yeah.
So in year 2, that 6% return is on a larger base than year 1, and so on and so on.
Exponentially.
Precisely. Yeah. Now imagine a smaller snowball growing at 3%. The difference between those two snowballs over 30 or 40 years of investing, it isn't just double. It can literally be the difference between a comfortable retirement and genuine financial independence, or even, significant multi-generational wealth. The implication here is just profound. Over any 20-year period, or certainly longer, stocks have consistently, demonstrably outperformed all other major asset classes. And this holds true despite the short-term volatility that often grabs headlines and, frankly, can lead investors astray. It's a testament to the fundamental engine of economic growth that corporations represent.
Okay, you've laid out a really compelling long-term picture there. But let's be honest, right? Our immediate experience of the market is often one of dramatic headlines. Fear. We all see those scary headlines. We see market crashes, corrections, moments where it feels like the bottom is just falling out. So if stocks are so volatile in the short term, how can they possibly be considered a stable long-term wealth builder? It feels contradictory,
It does.
almost like a paradox, right? How does Siegel reconcile that short-term chaos with his message of long-term stability?
It's a very common and completely understandable concern. And it's precisely where Siegel makes this crucial distinction. He helps us understand the fundamental difference between short-term noise and the profound long-term signal that truly matters for building wealth.
Mhm.
When you look at one-year volatility for stocks, yeah, it can be quite high. The market can swing wildly. A 20% or even 30% drop in a single year. It's not unheard of.
Right, we've seen that.
Absolutely.
Okay.
But as you extend that time frame, that volatility starts to diminish significantly. Over a 10-year period, the fluctuations are much lower. And by the time you reach a 30-year period, the volatility stabilizes profoundly. It almost flattens out. Siegel's rolling return charts, they clearly demonstrate this. Over 20 years or more, the likelihood of actually losing money in broadly invested stocks, say, through a diversified index fund tracking the S&P 500, it's statistically close to zero.
Close to zero over 20 years.
Pretty much. And this isn't just theoretical. It's borne out by over 2 centuries of historical data. For example, that S&P 500 average annual real return of 6.7% we mentioned, that's based on nearly a century of performance, 1926 to 2023. It encompasses every major economic crisis, every war, every boom, every bust. This consistent real return highlights the just remarkable resilience and unwavering long-term upward trajectory of the stock market, driven by human innovation, productivity gains, corporate profitability. Think of it like a long ocean journey. You'll have rough waves on the surface, definitely. But the underlying current, the deep ocean, it's steadily moving in one direction, upwards.
I like that analogy, and this connects directly to the power of those long time frames we just discussed. Siegel provides a very simple yet incredibly powerful formula. Future wealth equals 1 plus real return raised to the power of years. This isn't just math, is it? Can you break down just how impactful that formula is, why time isn't just a factor, but truly the greatest wealth multiplier we have?
Absolutely. This formula, future wealth, 1 plus real return years, it beautifully illustrates what we often call the miracle of compounding. Even a seemingly modest real return, let's stick with 6% annually after inflation, which is actually a bit conservative compared to the S&P 500, historically becomes incredibly powerful when compounded across decades.
Yeah.
Let's just picture this. Imagine you invest, say, $10,000. After 1 year, at 6% real return, it grows to $10,600. Okay, straightforward.
Yep.
But in the second year, your return isn't just on your initial $10,000. It's on the new, larger base of $10,600.
Right.
So you earn 6% of the growth you already achieved. And the snowball effect, where your money starts earning money on the money it already earned, it accelerates dramatically over time.
Okay, be the numbers.
Okay, consider the difference. If you earned a flat 6% simple interest on $10,000 for 30 years, right, no compounding, you'd have your initial $10 plus $18K in interest, $600 a year, times 30, total, $28,000.
Right.
But with compounding, that same $10,000 invested at 6% real return would grow to roughly $57,435 in 30 years.
Wow, more than double.
More than double, just from letting the returns build on themselves. And over 40 years, it's multiplied by over 10 times. This exponential growth is precisely why investing early and consistently is so critical. Time gives those positive returns the space, the opportunity to compound exponentially. It transforms relatively small, consistent contributions into truly substantial wealth. It really emphasizes that while individual years can be unpredictable, the long-term trend, driven by corporate earnings and economic growth, is profoundly, powerfully upward. It's why patience isn't just a virtue in investing, it's like a core strategy.
That concept of long-term stability and the power of compounding is so crucial. But okay, while time is an ally, there's another pervasive force always at play, always threatening our purchasing power: inflation. We've all felt the pinch of rising prices, right? Groceries, gas, just the cost of living going up. We often hear that fixed income assets, like bonds, they get absolutely crushed by inflation.
They do.
So what does Siegel say about how stocks protect us against this, this insidious erosion of purchasing power, especially when bonds seem so vulnerable?
Yeah. This is one of Siegel's most compelling and honestly liberating arguments for equities. And it goes right to the fundamental nature of what you own when you buy a stock. You're not just owning a piece of paper or a promise to pay. You're owning a piece of a real, business,
Mm,
a share in its productive capacity.
right. Ownership.
Exactly. And real businesses, unlike fixed income assets, possess these natural intrinsic mechanisms to protect themselves against inflation. They can, for example, raise prices on their products and services. They have to, right?
Mm,
To reflect rising input costs like raw materials or labor.
makes sense.
They can also adjust wages over time, passing those costs through their products. And critically, successful businesses have the ability to maintain or even grow their profit margins in an inflationary environment.
Mm.
Thanks to their pricing power, brand loyalty, maybe they offer essential services. This gives them an inherent adaptability that bonds, which are just a fixed promise to pay a certain amount, simply don't possess.
So bonds are static, stocks are dynamic.
In a way, yes. Historically, Siegel provides just clear, irrefutable evidence of this inflation protection. Think back to periods of high inflation, the post-World War II inflation in the 1940s, significant price increases as the economy transitioned, or consider the notorious stagflation of the 1970s and early 80s.
Oh, yeah, the 70s. High inflation, slow growth.
Exactly. Average inflation soared to around 7.1% annually from 1970 to 1981, paired with sluggish growth, high unemployment, nightmare scenario. During those periods, bonds often delivered deeply negative real returns, sometimes as low as -4% annually.
Meaning you were losing buying power every year.
Literally evaporating year after year. But stocks, while they might have struggled initially, sure, facing rising costs and uncertainty, they consistently recovered. And they outperformed both fixed income and cash assets within just a few years, sometimes even within months. We saw this resilience again after the huge monetary expansion of 2008. And more recently, following the, well, unprecedented money supply surge during the COVID pandemic from 2020 to 2023, in all these cases, equities proved their innate ability to adjust to a new inflationary reality, ultimately protecting and growing real wealth. And this stands in stark contrast to bonds, which, as you said, really bore the brunt of those inflationary pressures over the full economic cycle.
So this raises an important question for you, the listener, doesn't it?
Absolutely.
If knowledge is power, then understanding this fundamental difference that stocks are a natural, dynamic hedge against inflation because they represent ownership in real, adaptable, profit-generating businesses, well, that's absolutely crucial for anyone planning their financial future, especially given all the talk about inflation these days.
It really reshapes how you might view safe assets and what true financial security means over decades.
Okay, that deep dive into inflation protection is incredibly clarifying. You know, when we typically talk about stock returns, our minds often immediately jump to capital appreciation, how much the stock price goes up. We think about a stock moving from $100 to $110 or maybe $1,000. But Siegel points to another massive contributor to total returns, one that often gets completely overlooked or at least significantly underestimated in, public discussion. He calls it the unsung hero of long-term stock market wealth, dividends. What exactly is their profound impact? Why are they so important?
That's an excellent point to highlight, and it's truly one of Siegel's most important insights, one that often gets overshadowed by the flashy headlines of soaring stock prices.
Mm.
While price appreciation certainly contributes to returns, the profound impact of dividends, especially when they are systematically reinvested, it just cannot be overstated. Siegel's meticulous research reveals a stunning fact. Since 1871, dividends have contributed approximately 40% of the total long-term stock returns.
40%. Nearly half.
Nearly half. Think about that. Over more than a century and a half, nearly half the wealth generated by stocks has come from these regular cash payouts from companies to their owners, the shareholders. The full picture of your total return is actually a combination of price appreciation plus dividends reinvested.
Okay.
When you receive a dividend payment, which is basically a share of the company's profits being paid out, and you use it to buy more shares of that same company, or maybe more shares in a diversified index fund, you are literally turbocharging your compounding engine.
How so?
Well, those newly acquired shares, they then go on to earn their own dividends and their own price appreciation. It creates this powerful self-reinforcing cycle. It's like adding more fuel to an already efficient engine, making it run even faster.
Got it. Dividends buy more shares, which earn more dividends.
Exactly. A fantastic real-life example Siegel uses is Coca-Cola. He highlights that from 1960 to 2020, Coke paid uninterrupted dividends for over 60 years. Now, for an investor who just bought the stock and held it, the price appreciation was significant, no doubt. But for an investor who systematically reinvested every single dividend back into more Coke shares, the return was just astounding.
Give us a sense of that difference.
Okay, let's make it concrete. If you had invested, say, $10,000 in Coca-Cola back in 1960 and just held the stock, maybe pocketed the dividends, your investment would have grown significantly, sure, maybe to a few $100,000 over 60 years.
Still great.
So pretty good, definitely. But if you had reinvested every single dividend payment, that initial $10,000 could have grown to over $1 million.
Whoa, over 100 times the initial investment.
Over 100x. And this wasn't just the stock price going up. It was the exponential compounding power of those reinvested dividends, constantly buying more shares, which then generated even more dividends, and on and on. And this leads to a crucial strategic implication Siegel emphasizes. Companies with a history of paying rising dividends, often called dividend aristocrats or dividend champions, because they've consistently increased payouts for decades.
Right, those reliable payers.
Exactly. They have frequently outperformed the growth-only firms over decades. These aren't necessarily flashy, high-flying tech stocks sometimes. They're often established, financially robust companies. They demonstrate consistent profitability, strong financial health, and a commitment to returning value to shareholders. And that often translates into superior long-term performance, even if their share price growth isn't always making headlines in the short term.
So this isn't just about generating income in retirement, though that's part of it.
Not at all. It's about setting up an exponential growth engine that can fundamentally change your wealth trajectory, allowing your money to truly work for you, compounding year after year, almost silently building your fortune.
Okay, so we've established the long-term trend for stocks is powerfully upward, and that dividends are a critical, often overlooked engine for wealth creation. But let's turn to what is arguably the biggest psychological hurdle for investors. Those moments when the market feels like it's just falling apart.
The panic moments.
Exactly. When we're in the midst of a crisis, panic is setting in, the instinct to run for cover is just overwhelming. Many listeners might be thinking, sure, the S&P 500 historically recovers, but what about my portfolio when it's down 30% or 50%? What does Siegel say about the psychological impact of those drops? How does his data actually calm that fear?
This is where Siegel's analysis of market crashes becomes not just academic, but profoundly reassuring. Yet also, maybe one of the most difficult lessons for us humans to internalize. He meticulously reviews every major market downturn in history. The devastating Great Depression, 1929, stocks lost nearly 90%. Black Monday in '87, the dot-com bubble bursting in 2000, the global financial crisis of '08, even the lightning-fast COVID crash in March 2020. His consistent, unwavering finding, every single one of these crashes, without exception, has been followed by a recovery.
Every single one.
Every one, and not just a recovery, but a full recovery of losses, typically within 5 to 10 years max, and often followed by new highs. Let's delve into a few. The dot-com bubble, 1999-2000. That's a powerful cautionary tale. Speculative fervor, investors pouring money into internet companies, many with little or no revenue, no profit.
Believing this time it's different.
Exactly. Believing traditional valuation metrics no longer applied. Chasing new paradigms at utterly absurd 1,000x price-to-earnings ratios.
1,000 times earnings, that's insane.
It means investors were willing to pay 1,000 times a company's annual earnings. A clear signal of speculative excess, unsustainable valuation. The Nasdaq ultimately fell a devastating 78% in just 2 years. And while the broader market recovered, many of those highly speculative stocks, they never did, just disappeared entirely. It vividly illustrates the danger of chasing those speculative trends.
Okay, then what about 2008? That felt really systemic.
Oh, the global financial crisis. It felt like the world was ending for many investors, right? The S&P 500 fell about 57% from its peak in October '07 to the bottom in March '09. It was brutal, stomach churning, driven by the housing market collapse, near meltdown of the financial system. Yet for those who simply stayed invested, who held their ground, endured the fear, the market fully recovered in just 4.5 years.
4.5 years from that kind of drop.
Yeah, and more astonishingly, if you had stayed invested through that period, the decade after, from 2009 to 2019, yielded an annualized return of roughly 13%.
13% a year after that massive crash.
Exactly, making up for all the prior losses and then some. This means investors who held their ground, who didn't panic and sell at the bottom, they made massive gains. It proves that true courage in investing is often just doing nothing when everything around you screams to act.
And the COVID crash, that was incredibly fast.
Even more dramatic. March 2020, S&P 500 drops a staggering 34% in just 23 days, fastest bear market in history. But by August 2020, just 5 months later, it had fully recovered. 5 months. And the 3-year CAGR, that's the compound annual growth rate, the average annual growth over that period from 2020 to 2023 for those who remained invested, approximately 11%. The critical overriding lesson here is just crystal clear. Panic selling always leads to underperformance, and more importantly, to permanent loss of capital. Investors who stayed invested, and these weren't the traders trying to jump in and out, these were the patient long-term investors. They were the ones who built fortunes. This ties right into the futility of market timing. Another destructive behavioral trap Siegel highlights, missing just the top 10 best days in the market, which, interestingly, often occur during periods of chaos and uncertainty as markets snap back.
Right when you're most likely to be out.
Exactly. Missing just those few best days can reduce your returns by a staggering 35% over a period like 1990 to 2020, consistently timing the market. Buying the absolute bottom, selling the absolute top. It's simply impossible for us mere mortals.
That's a powerful point. And it really highlights how much our human brains can sometimes work against us, even with all this compelling data. We're wired for fight or flight, right? And a market crash definitely feels like a flight moment. So even with all the historical proof that staying invested wins, what are some of those other common behavioral traps Siegel warns us about, beyond just panic selling? And crucially, what are his suggested remedies to help us overcome our own worst instincts?
You've hit on such a critical aspect of investing. It's not just about the numbers, the data, it's profoundly about mastering your own psychology. And Siegel dedicates significant attention to these behavioral biases because, frankly, they are arguably the biggest threat to your long-term wealth creation, far more damaging than any market downturn. Common traps include, well, investors tending to chase performance, jumping into what's hot, what's rising, only to buy near the peak, that classic FOMO, fear of missing out.
We've all felt that.
Absolutely. They also overreact to news, whether it's a good earnings report or some geopolitical event, making rash buy or sell decisions based purely on emotion, not strategy. And of course, they often ignore the insidious, silent impact of fees and taxes on their long-term returns. Those can just quietly erode wealth over time. The dot-com bubble we just talked about, that's the quintessential example of these biases playing out. Investors, fueled by speculative frenzy, overconfidence, poured money into unproven internet companies. They had a severe case of loss aversion, didn't want to miss out on those incredible but ultimately unsustainable gains. When the bubble burst, that overconfidence turned into panic. Many froze or sold right at the bottom, experiencing permanent losses as the Nasdaq fell nearly 80% and countless companies just vanished.
Yeah, painful memories for some.
It vividly illustrates how overconfidence, FOMO, followed by paralysis when facing losses, can lead to disastrous outcomes for individual portfolios. So Siegel, ever the pragmatist, offers clear, discipline-focused remedies to counteract these inherent human tendencies. One of the most effective and deceptively simple is dollar-cost averaging, DCA.
Okay, explain DCA simply.
It just means investing a fixed amount of money at regular intervals, say $500 every single month, regardless of what the market is doing. Up, down, sideways, doesn't matter. $500 goes in. The beauty of DCA is that it automatically forces you to buy more shares when prices are low and fewer shares when prices are high. It effectively smooths out your average cost over time.
Takes the emotion out.
Completely removes the emotional bias.
Yeah.
Takes the timing out of the equation. Siegel gives a compelling example. If you had invested $500 a month in the S&P 500 from 2007 to 2017, starting right before the 2008 crash, yeah, seems like bad timing, right? But your consistent investments meant you were buying significantly more shares during the market downturn when prices were cheap. As a result, your average cost per share ended up being below the market price after just 5 years, giving you a strong position for the recovery. You were literally programmed to do the intelligent thing, buying low, even when it felt totally counterintuitive.
That's brilliant in its simplicity. Any other disciplines?
Yeah, beyond DCA, he also advocates for periodic portfolio rebalancing. This just means occasionally adjusting your asset allocation back to your target percentages. So for instance, if stocks have had a huge run and dramatically outperformed your bonds, you might sell a portion of your stocks and buy more bonds. It maintains your desired risk balance, and it effectively locks in some gains, prevents your portfolio from drifting too far from your comfort zone.
Makes sense. Keep things aligned.
Exactly. Ultimately, Siegel is a strong proponent of low-cost index investing as a systematic way to eliminate nearly all of these destructive behavioral biases. It's about setting a clear, rational course and just sticking to it, letting the market's long-term upward trend do the heavy lifting, rather than fighting your own human nature or trying to predict the unpredictable.
So this is not just about crunching numbers.
Not at all.
It's about mastering your own psychology. This feels like where the aha moment really kicks in for many people, realizing that success in investing is often more about consistent, disciplined behavior than about, exceptional brilliance or market foresight.
Precisely. That's the core message.
Okay, that's an incredible insight into human behavior, and frankly, a relief to hear there are practical strategies to combat our own worst instincts. So, if broad market stocks are so great, long-term outperformance, inflation hedging, dividend power, does that mean we should just put all our eggs in one U.S. basket? Or does diversification, particularly internationally, still play a crucial role in Siegel's framework?
It's a very nuanced question, actually. Siegel provides a balanced, thoughtful perspective that, again, challenges some traditional assumptions. Diversification, broadly speaking, always a sound principle in investing. International diversification specifically helps reduce region-specific risks. If one country faces an economic downturn.
Right. Don't put all your geographic eggs in one basket either.
Exactly. It also helps with currency risks, geopolitical risks. If a particular country or bloc faces political instability or an economic crisis, having exposure elsewhere can certainly cushion the blow to your overall portfolio. Historically, though, the performance of international markets compared to the U.S. has been pretty cyclical, often rotating leadership. For example, Siegel notes the MSCI Emerging Markets Index. That's a key benchmark tracking developing world stocks. It delivered an impressive roughly 35% compound annual growth rate from 2003 to 2007, significantly outperformed the U.S. during that period, fueled by rapid growth in places like China and India.
Okay, so EMs were hot then.
Very hot. However, from 2008 to 2015, those same emerging markets significantly underperformed the U.S. market. They got hit hard by the global financial crisis and a subsequent slowdown. And then more recently, say 2021 to 2023, we've again seen a rotation back to strong U.S. outperformance, driven by innovation tech, relative economic strength.
So it goes back and forth.
It does. And Siegel's key insight here is really twofold. First, while international diversification is generally good for managing risk and capturing global growth, U.S. equities have historically led over the very long term. They've demonstrated remarkable resilience and innovation. Second, and this is a crucial point many investors overlook, is the concept of implicit global exposure.
Implicit, what do you mean?
What I mean is many major U.S. firms, think Apple, Coca-Cola, Microsoft, companies Siegel mentions are, in reality, global operations.
Right. They sell everywhere.
Exactly. They derive significant portions of their revenue and profits from outside the United States. Apple sells iPhones globally. Coke sells beverages in nearly every country. Microsoft software is used worldwide. This means that by simply owning a diversified portfolio of large, multinational U.S. companies, you often gain substantial implicit global exposure, even without directly investing in international ETFs or funds.
That's a really interesting point. You might be more global than you think, just owning U.S. stocks.
You very well might be. So while directly investing in international markets can reduce some specific risks, Siegel's research suggests it hasn't necessarily guaranteed superior long-term returns compared to a well-diversified U.S. equity portfolio. This raises an important question for you, the listener. How much explicit global exposure do you really need? Or do you already have quite a bit, implicitly, just by owning companies that operate worldwide? It's about being strategically diversified, understanding the underlying business realities, rather than just geographically diversified for its own sake.
This has been incredibly insightful, really connecting the hard data to human psychology. Which brings us to a really critical stage in life, retirement planning. We're often told, almost like it's gospel, right, that as we near retirement, we should heavily shift our portfolios into bonds, move almost entirely away from those riskier stocks. It's the traditional glide path of investing.
Yeah, de-risking, they call it.
Exactly. But Siegel, true to form, offers a different perspective, one that sharply challenges this conventional wisdom, especially given his long-term view and his insights on inflation. So what does this all mean for retirees, for those decades after you stop working?
This is indeed a vital area where Siegel challenges what has arguably become outdated financial advice. The traditional wisdom of moving heavily into bonds in retirement. It was largely based on a time when retirement might have lasted, say, 10 or 15 years, a relatively short period.
Right. Things have changed.
Dramatically. Now, thanks to advances in healthcare, lifestyle, people are living much, much longer. Retirees often face 20, 30, or even more years post-retirement. This extended longevity completely changes the risk profile. If your retirement is going to last 3 decades, inflation risk becomes a massive, corrosive threat to your purchasing power.
Because bond payments are fixed.
Exactly. Fixed income bond payments, by their very nature, do not adjust for inflation. So while your bond payments might remain nominally the same year after year, their real value, their ability to buy groceries or pay for healthcare, could significantly erode over time. It's a hidden risk for long retirements. Siegel argues that